cryptocurrency taxation and reporting transactions on your balance sheet differ. Here's how to treat cryptocurrency on your balance sheet. Currently, no accounting standards are dedicated to crypto assets, so broader guidelines per the International Financial Reporting Standards and generally accepted accounting practice are applied to cryptocurrency accounting. Balance sheets are among the three primary financial statements that businesses need alongside income and cash flow statements. Whereas income and cash flow statements show a business's economic activity over a certain period, a balance sheet shows how many assets it has and whether it has equity and any debt. There are two businesses, their building balance, their kitchen balances, building balance is also maybe second balance, financial situation, but has been on the scale and maybe the business started. For this reason, crypto transactions ought to be included, especially those that impact a business's financial situation. The balance sheet provides valuable insights into a business's financial health and offers key benefits. Since balance sheets are typically prepared at the end of a specific reporting period, they allow one to compare business performance year over year. As such, balance sheets provide a measurable way to track the growth and progress of one's business. Balance sheets also allow one to calculate key financial ratios, such as the debt-to-equity ratio, which shows whether or not a business can pay off its debts with it's the fact that it's its name for our neighbors, it's an ear in our neighbors. This side of vested, the DMRT will be able to 24 months. And lastly, balance sheets allow one to reasonably evaluate the business, so this can be helpful when looking for investors to prove that they will enjoy profitable returns or when looking to sell the business. One of the most common questions when preparing a balance sheet is, where does crypto go on the balance sheet? As mentioned previously, both the IFRS and GAAP do or not currently have any specific references with regard to crypto bookkeeping. So, however, since cryptocurrencies qualify as assets, the core principles of accounting for assets apply when preparing a balance sheet that includes crypto transactions. Here are some helpful pointers. Cryptocurrency trading activities should be recorded similarly to those of stock trading activities. If one buys Bitcoin or Ether, these digital assets can be added to the balance sheet at their fair market value on the date the assets were purchased. This will reflect as a debit on one's assets account. Additionally, since the cryptocurrency was purchased with fiat currency, the cash account should also reflect the credit for the purchase price of the acquired crypto assets. When selling cryptocurrency, however, the assets account will be credited and the cash account will be debited with the amount of fiat received upon selling the cryptocurrency. Suppose there's a significant difference between the sale amount of the cryptocurrency versus the amount paid for it. Original purchase price, in that case, a capital gains account who should also be credited. In following GAAP's accounting rules on intangible assets, impairment losses can't be reversed even if the asset recovers in previous price levels. If a business purchases BTC with a fair value of $500,000, which then drops by $100,000, then the company has to recognize that loss and reduce its cryptocurrency holdings to reflect the decrease in value. And this holds even if the fair value later increases to $600,000. The loss can't be reversed or increased in value on the balance sheet. Per GAAP guidelines, the impaired value in this scenario will remain at $400,000. Businesses that engage in cryptocurrency mining must record cryptocurrency profits in their balance sheet, like other income generating activities. This means their mining income account will be credited, then newly generated digital asset will need to be debited onto their books at the asset's fair market value. And I think it was similar to see with the 65 years that are in subcaches. At the end of the cache,
It is a highest shot that made it with a big rest of the signs and credited. The corresponding asset account will then be debited by mining equipment that has to be capitalized and amortized, or otherwise recorded as an expense for things such as supplies and utilities.
When using cryptocurrency to pay a supplier or vendor, it qualifies as a disposal and should thus be recorded in the same way as selling the cryptocurrency, i.e. assets, account credited. A capital gain will therefore be recognized for the difference between the expense and the book value of the asset. For example, if one has 100 BTC equivalent to $300,000, and the BTC has since increased in fair value to $400,000, but then paid a certified public accountant firm who did the audit $400,000 worth of BTC instead of cash, the amount will need to be debited to their professional services expense account. Meanwhile, the BTC asset account will need to be credited $300,000. The remaining $100,000 balance will then be credited to a capital gains account. Tax compliance is an essential part of accounting for cryptocurrencies. As mentioned earlier, when cryptocurrencies are sold, it is considered capital disposal as per the current guidelines on assets. Whenever the profits from capital disposal are higher than the price the cryptocurrency was purchased at, cryptocurrency incurs a capital gains tax. However, when proceeds are lower than the same purchase price, it incurs a capital loss. Capital losses may then be used to balance out capital gains on other assets or carried over to the next financial year. In any case, it can reduce one's tax liability. When someone is paid in cryptocurrencies such as BTC or ETH, they will be liable for income tax. The market value of the cryptocurrency at the time of the transaction should be used to account for such under one's trading profits. Companies also need to pay corporation tax on said profits. Taxation and accounting are intrinsically linked, but the rules that apply to both do not align under all circumstances. For instance, unrealized cryptocurrency losses will require one to keep journal entries under both IFRS and GAAP rules, especially concerning impairment events, during which there wouldn't be a deduction on taxes for such losses. And cryptocurrency taxes can be complicated, but financial reporting for accounting purposes can be even more mind-boggling in several instances. To avoid confusion, cryptocurrency transaction recordings are often split in two groups based on cryptocurrency taxes: transactions that generate income taxes and transactions that generate capital gains taxes, and taxable events that cause businesses to owe income taxes on an asset's fair market value under GAAP and IFRS are as follows. For this reason, all the above activities should be recorded as gross revenue for the year. These will be taxable as ordinary business income, but all ordinary and necessary expenses resulting from these activities will be deductible. As for events that trigger capital gains or losses, all transactions that fall under the category of capital disposal of cryptocurrency for proceeds, and that differ from their cost, that are in serial, that basis are considered selling cryptocurrency, exchanging cryptocurrency, using cryptocurrency to pay a supplier or a vendor. The cryptocurrency transactions that are non-taxable events are those that do not contribute to the tax liability of one's business. These include, and the basis of prudent financial management is accurate accounting for gains and losses. It plays a crucial role in ensuring that financial reporting is transparent and trustworthy, is an end essential for stakeholders like investors, creditors, and regulatory authorities to evaluate an entity's performance and financial health. Accordingly, careful accounting guarantees compliance with laws and gives people, companies, and organizations the power to make tactical decisions that can result in sustainability and long-term success.